Hey everybody, in this video I wanted to do a quick breakdown or a quick run through on the theory of risk and confirmation entries, how to position yourselves in terms of identifying the point of interest and then looking for entries, whether it be a risk entry or a confirmation entry, and breaking those two entries down a little bit further. This is going to be strictly theory, so there won't actually be chart examples in this video, but I hope this clears up some of the confusion around the two entries. I've alluded to this in a few commentaries and touched on it in the initial entries video, but I feel like having this theory component might take it to that next level to really showcase the power of the different entry models that we can utilize, and hopefully that this will allow you to improve your strike rate and really improve the trades that you are taking by allowing you to give yourself increased confluence on the points of interest in terms of your execution timeframes. So let's dig into it. Let's do a quick breakdown of how to best approach this strategy, how to basically, from a theoretical standpoint, approach how we should be looking for entries, how we should be viewing the markets, and basically the best way to approach it. So let's do an example. Let's say price is in a downtrend on the higher time frame. We see price break structure, break the low, and then price moves to the upside, breaking the high. So now we're in an uptrend. We formed a point of interest right here. We wait for price to come down to that point of interest, move to the upside, and break structure. Now we can choose to enter at this break of structure at this point of interest, or we can wait for this break of structure to confirm the trend more so, because of course we've seen price move to the downside, break structure, move to the upside, break structure the opposite way. So it is possible that price could just break down again. So this gives a little bit more solidification that an up move is beginning. So once we tap into that, we can see price moving to the upside. So if we just mark this out, we can see that we have a break of structure to the downside. Then we also have a break of structure to the upside, followed by another break of structure to the upside, and finally another break of structure to the upside. So when we're marking out points of interest, our first entry could be here depending on your risk tolerance, but there's also another entry that could be here. Now, if we take this a step further, we can take a look at, say that this is either the daily or the 4-hour or even the 1-hour market structure. This is what's happening. So if we look at these points right here as price taps into this order block. So say we drop down to a 15, a 5, or a 1 minute chart, depending on what you use. Basically what we want to look for is the same market pattern, just on a smaller time frame. And this is taking advantage of the fractal nature of the markets. So again, what we're looking at is a break of structure because we're in a downtrend here. This leg would be a downtrend on a smaller time frame. We wait for price to break structure to the upside, which then would form another point of interest that we can look at to enter on. But again, since price was moving down to the downside, creating lower lows and lower highs, we broke structure, which still confirmed a further down move. Then price broke this swing high, creating a higher high, but we haven't actually confirmed any structure. We're just starting to show the beginning of an uptrend, but it is possible that we could do something like that, which would be basically a run on the liquidity before a move to the downside. So this entry is very possible, but it's also risky. So what we can do is just wait until price breaks structure one more time and then enter on this order block. So again, this is the exact same pattern. It's just replicated on a lower time frame, taking advantage of the fractal market nature. And again, we can also look for this type of market structure or this pattern to occur on the second point. So basically what we'd be looking at is the more risky confirmation entry. This would be the confirmation entry, and this would be the more safe confirmation entry. And of course, within that, we have the opportunity to potentially get a risky confirmation entry and a confirmation of the confirmation entry. Now, of course, something to keep in mind, we're not always going to get this second mitigation, the second entry potential, but what this also will do is help increase your strike rate overall, which is going to massively help if you're seeing loss after loss. This helps confirm the trend. So if you're waiting for that break of structure to the upside, yes, you can enter here, but you can also drop down to a lower time frame and basically trade the exact same fractal pattern. That gives you a little bit more precision and a little bit more confirmation within the entry. So now that we have this marked up, this gives us a better understanding of how to approach entries. Again, we're looking for price to create a point of interest on a higher time frame, whether that's the daily, the 4-hour, or the 1-hour. And when price taps into that point of interest for the first time, we have the opportunity to take more of a risk entry. The reason it's a risk entry is the trend hasn't necessarily been confirmed yet. Yes, we have switched from bearish to bullish in this case, but it is possible that this could be a liquidity grab for price to continue lower. But of course, what we can do instead of just setting an order on that higher time frame is we can then drop down to our lower time frame execution timeframes, whether it be the 15-minute, the 5-minute, 1 minute, whichever you use, and look for a fractal pattern of that. And again, we can approach it in two different ways on this first risk entry spot. We can take the first risky entry of that fractal pattern, which would be that first mitigation, or we can wait for that second break of structure to enter a confirmation entry and take longer. This entry will give you a little bit more confirmation and also improve your strike rate as the trend has confirmed. We're seeing a succession of higher highs and higher lows being formed, but not all the time will this entry come. So sometimes you will miss trades if you are only waiting for that. And entry 1 is more risky because we haven't confirmed the trend yet and we could very easily be stopped out. And then second entry that we can do, again, is we wait for price to break structure on that higher time frame, come back down to another point of interest that has been created, creating bullish order flow. We're seeing higher highs and higher lows forming. And again, instead of putting a limit order on this higher time frame point of interest, we can drop down to our lower time frame execution timeframes, 15-minute, 5-minute, 1 minute, and look for a confirmation entry. And in this case, we have entry 1, which would be the risk entry of the confirmation, which would be that first break of structure and into the first point of interest. Or we have the second, which would be a confirmation entry within a confirmation entry, where we're seeing that succession of higher highs and higher lows being created. And we take our entry on that second point of interest to take the trade long.